Hello and welcome to our Minds and Money 5 at 5 show, brought to you in association with RGN, Resource Global and Network. For those of you attending 5 at 5 for the first time, the aim of 5 at 5, 5 guests at 5 p.m, is to maintain engagement between investors and miners through a lively, interactive format during the current situation. A few admin announcements before we start. To make it as interactive as possible, please have your video switched on. To ask a question, you have two options. You can either submit them via the chat function, which is at the bottom of the screen, or even better, you can wave your hands via the invite participants function. Again, that's also at the bottom of the screen. I will unmute you, and you can then ask your question live. Being towards the end of the week, we encourage you to bring along a glass of wine or a beer to relax, sit back, and enjoy. And talking of wine, that brings us to our first polling question of today's webinar. So, Minna, can we go and get our first polling question up on the screen? And the question for you, to kind of get you used to using the polling system, is which country invented wine? You've got a choice of 5 choices there. You've got a choice of China, Egypt, France, Georgia, or Greece. So I'll just go and give you a little bit longer just to go and vote.
You should have had none of the above.
This week's guest.
Where would you come from?
So for this week's show, we've got a star-studded lineup of guests, including Marcel de Groot, co-founder of Pathway Capital. We also have Simon Popple, founder of Brookville Capital, one of the UK's leading mining newsletter writers. Daniel Major, CEO of Goviex Uranium, a mining company which has projects in Mali, Niger, and Zambia. And Scott Treblecock, CEO of Core Mining, which has 4 100% owned gold projects. So let's close the poll and have the answers up. And for those of you who said Georgia, I'm amazed because you are 100% right. It was Georgia that invented wine. And if you don't believe me, go and Google Wikipedia. So without sort of like further ado, let's please go on to review some of the mining news stories of the last 2 weeks. And probably I'd like to start off by asking our 2 investors, Marcel and Simon, perhaps you can pick out one mining news story over the last 2 weeks that has caught your attention. Perhaps I could ask yourself first, Simon, followed by Marcel.
Yeah, well, the first big news that sort of caught my eye was the fact that the gold price has actually outperformed Berkshire Hathaway, so Warren Buffett's flagship fund or vehicle, over the last 20 years, which I was pretty amazed by, to be honest.
Okay, and yourself, Marcel?
Well, I was surprised by the recent move in copper. Copper just spiked up quite significantly as a result of Chinese demand and issues with respect to supply in places like Chile, and so that was something that was a pleasant surprise.
Mm-hmm. And just going to bring in our 2 mining guests, Daniel and Scott. Maybe to yourself first, Scott. Any particular like mining sort of stories that caught your eye over the last few weeks?
Yeah, I mean, to me, at a small junior company, it's really the flows of capital. So I think we've started to see in Canadian capital markets, a good flow of generalist money starting to come into the sector, and I think that's really going to give some nitro firepower to the gold equities.
Sure. And actually, for that generous flow of capital, is there any linkage in there between to that and to mining companies becoming more ESG compliant, or is it kind of just due to the downturn in other sectors and perhaps the mining sector looking more attractive than other verticals?
No, I mean, ESG is obviously desperately important, and I think for a long time has been for mining companies, but I really think it's fund managers allocating just that little bit of extra capital to call it the hedge. And it's just, the gold's still such a small sector compared to the other sectors that just a little bit of capital allocation in each portfolio can create some massive runs. So I think it's mostly the asset class.
Sure. And moving on to you, Daniel, what's been the news story that sort of caught your eye over the last few weeks?
Couple interrelated ones, all China related. Massive increase in buying from China for commodities. We've seen them take another opportunity to fill up the stockpile while nobody else is looking. and then increasing trade war now starting. You saw them now sanctioning Lockheed. So we're starting to see them use their firepower on some of the rare earths, the other metals, where they have 80% of the world's supply and now using metals as a political tool. So, you know, since we've come out of COVID in that direction, China is starting to flex its muscles a bit with its ability to handle metals themselves.
Sure. And the question for you, Daniel, yeah, and a question for you, Daniel, or actually like any of the other panelists. We've obviously got the US presidential elections coming up this November. If there is a change in president in the US and Joseph Biden wins, will that lessen the US-China trade war, or is that still going to be a long-term trend?
No, I think you'll see a lot of things softening. I think you'll head back, hopefully not as far as the Obama deference, but I think you will still see a stronger position. Once Biden's come out with his Buy America clause, which is rather slightly different angle than the Great Make America Great. So I think you will see a tendency to soften slightly there. We're not. I'm not particularly worried in my sector because Biden is actually pro-nuclear. So I'd rather him come in as a Democrat than anyone else, because at least there's a pro-nuclear stance coming with it, rather than some of the other candidates that were there before, which had anti-nuclear stances. So for us, you know, and I don't think, you know, a global trade war is anything anybody needs. You know, there's a lot of slapping and handbags going on at the moment, you know, and I don't think anybody actually needs it. If we need to find a way of compromise to move forward on it.
Sure. And coming back to Simon and Marcel, is it respectfully gold and copper? Are those the two commodities that you are respectfully most bullish about over the next sort of like year or so? For yourself, Simon, gold, and for yourself, Marcel, copper, or?
Yeah, I mean, this is the graph showing gold outperforming Berkshire Hathaway, and with all the money printing that's going on, I think that precious metals are, you know, I can't say anything that's going to hold them back, to be honest. And there's another chart that I don't have with me today, but I mean, it basically shows that if we were to repeat what happened in the late 1970s, early 1980s in terms of, you know, the boom in gold, you know, the 1900 mark, which was the previous high, you know, is nowhere near where it could go. So, you know, I'm very bullish on gold at the moment.
And yourself, Marcel, for copper?
Yeah, well, I think I'm bullish on copper in the longer term. The shorter term, I'm not so sure about. With respect to the gold trade, I think that the conditions have never been better. I mean, we're seeing money being printed at levels that have never been seen before globally, and fiscal monetary policy has opened up, and I just don't see how gold doesn't crack all-time highs by a far amount.
Okay, thank you very much for that. So let's move on to our first mining update of the show. As it's on uranium, let's bring up our second interactive poll. So perhaps a minute we can have the second interactive poll up on the screen, which is, are uranium companies now more or less attractive as an investment since January? So we should be having the polling question coming up on the screen now. You've got five options: significantly more attractive, slightly more attractive as 2019, slightly less attractive, or significantly less attractive. And again, whilst you're voting, let me introduce our first mining update, who is Daniel Major, CEO of Goviex Uranium. Goviex Uranium are a mineral resource company focused on exploration and development of their African uranium properties. Goviex's principal objective is to become a significant uranium producer through the continued exploration and development of its mine-permitted Madiola project in Niger, its mine-permitted Mutanga project in Zambia, and its Falia project in Mali. So can we please close the polling, Minna? And I think we've got slight advantage. 44% say uranium companies are slightly more attractive than they were last year. So I'm sure that Daniel will be telling us why uranium is significantly more attractive and why Goviex Uranium is your best bet. So over to you, Daniel.
Yeah, no, at least we're on the positive side on the votes. I'll take that as a good sign. Yeah, I mean, uranium is a metal has been in a bear market since 2011. I mean, we've just been struggling along with various things, massive oversupply, closures of reactors. We've now seen that turn around. You're now looking at more energy generated from was Fukushima. You've got a 2% per annum growth in nuclear generation build going out there. China's currently building between 6 and 8 reactors a year and turning those on, and these are big reactors. So it's a massive switch. You're waiting for Japan, to turn more of its reactors on. So very solid, but you've seen more importantly in 2019, moving into 2020 in particular, the industry continue to react against the declining price. So you had Cameco shut down the MacArthur River mine. You saw the Kazakhs reduce their production 20% below their required rate that they're regulated to do. That starting to squeeze inventory levels. Last year, inventories dropped in Europe, in the US. More importantly, producer inventories just collapsed. This year, COVID has brought a silver lining to my industry because it saw Cameco forced to close its last remaining mine in Canada, with Cigar Lake turned off, and it's still standing. And the Kazakhs were impacted as well, where they were not allowed to continue their development. So in the second half of the year, they're going to be down 10 million pounds. You're talking about an industry that produces about 140 million pounds a year. So 10 million pounds from the Kazakhs, the largest producer, not being around is a lot. And they don't have enough in inventory to meet their contract. So they're going to have to come into the market and buy. You've seen Cameco already buying and having to increase their buying because of the shutdown of Cigar Lake. So, you know, it's been interesting. You haven't seen the utilities buying this year in large volumes. They tend to come in the second year. So second half of this year could be really interesting for the uranium sector. You need a lot higher price to start turning projects on. We're running a supply deficit at the moment. Inventories in decline. And that's where we kind of sit in here. We are a developer. We're fully, but the price has been so low that nobody can really get going. But because we got a permit, the metal price continues to rise, then we will be putting ourselves towards the production side. And then from a valuation point of view, companies that can re-rate from being a developer to being a producer, not only do you get the uranium price rise, you also get that developer re-rate story that comes through. And for those around in the 2004 to 2007 cycle, the two companies that re-rated, one of them doubled what the sector was doing, and the other one went up 5 times higher than the sector. There are only two companies that did it. So that was the good old days. If you got the right one, you made a 10,000% return on your money. So interesting times for uranium. When we had the last uranium bull, there were 500 uranium stocks. There's only 50 left. What is interesting is their increases starting to turn up. So something, the market's starting to heat up to uranium. There you go.
Okay, we've got a question sent in by one of the members of the audience, which is, what does thorium reactors do to uranium mining?
Thorium. It does nothing. Thorium's an interesting concept. It's been around for a while. No one has really developed it very far, but the permitting will take a really long time. So in my lifetime, I don't expect to see a thorium reactor turning up. I think the more important thing is that we're seeing increasing interest now from governmental bodies. You went back to 2011, everybody went kind of CND on us for a while. That has now changed. Even the DFC in the US, Department of Trade, are now willing to finance nuclear reactors. So World Bank type bodies are now willing to finance nuclear, which didn't happen. So thorium, it's a long way off. There are many other technologies in there as well, like the pebble beds, solid salt reactors. I think the biggest driver for our sector is not going to be that, is going to be the SMRs, the small modular reactors. The problem with the big reactors, they're like, 2.6 gigawatts of reactor. There's only 2 countries in the whole of Africa that can handle one of those reactors. That's the scale of them. The SMRs are really small. They go down to 10 meg, come on the back of a truck. That is going to game change our industry. A lot of jurisdictions can handle them. You can strip out a coal-fired power plant and put a reactor exactly in the same place and connect it to the grid. So I think the permitting of that as well will bring the cost down. They're not pressurized vessels. They've got a ton of safety features as long as there's no moving parts. So I think you're going to see that and costing drive away things like thorium.
Okay, and I'd like to just bring in one of our investors, Marcel. Marcel, what do you think of uranium as an investment? And do you have a question for Daniel?
Yeah, I mean, I think if the world is serious about reducing fossil fuels, the only feasible way of doing so is nuclear energy. Nuclear, and as outlined, the price is a small percentage of operating a reactor. On that topic, Daniel, how are you seeing the spot price compare to contract prices? Because you hear lots about how the contract price is higher than spot. How are you seeing that? The
spot's currently higher than the contract price, but that's because no one's traded a contract. So the contract's basically a dead price. If you look at the forward prices that are sitting out there, and you can get them on NYMEX, I mean, they're over $40. So it's starting to move up. You've got a nice little bit of backwardation building up on the Cameco contracts, which always tells you it's about to go a lot higher. So, we are seeing that coming through. The problem is the uncovered contract position. 20% of uranium sells in the spot market, 80% on the contract. The uncovered contracts are starting to appear. They will need to be covered to the point, because your big spot sellers, your Camecos, etc., won't sign contracts unless they can see 40s and 50s in front of them. The biggest spot seller that used to be out there, which was Kazatomprom, which is a 40% world producer, won't sell anything to the spot market any longer. So, it is a matter of time. I think the other thing, Marcel, is that the contract market is all about price protection for both sides. Once everybody starts to think the price is going to move, both sides, spot and the utilities and the producers, will want to get price protection in there. So, I think if we start to see a real move in the second half, you'll start to see being signed.
Okay. We've got quite a few questions being sent in. So I think the next question will take one from Jacob Ambrose Wilson of Resource Global Network. And he's asking, Daniel, what is the minimum uranium price required for projects to be constructed? And when do you expect the market to reach this break-even point?
You look at the 80% of the industry operates needs at least $60 to justify operating. So that tells you where the price should get to. If you look at most of the projects that are currently idle, they're going to need 60 plus. We currently have $60 for our project, but we're actually running our PFS and pulling that down, massive capital reductions, hopefully, and bringing our OPEX down through changing our process to get down to 50. 50 is my number that I'm targeting, because that's what Cameco said they want to restart their McArthur River operation. The world's best underground mine in uranium is still idle until they can see a $50 contract price out there. So, that kind of tells you where the market's going to do. The Kazakhs can operate a lot lower than that. I mean, they're making money at $15 break even. So they're happy bunnies. But what they've said is that when they won't increase production until McArthur restarts. So, my gut feel is the duopoly, which is Cameco and Kazatomprom, will try and balance the market somewhere between $50 and $60. That would be a price that both of them making a nice, tidy profit on. And it would stop some of the higher cost producers trying to get into the market as well. So, 50 to 60 is really the range you'd be looking at for the industry.
Okay. Question from me. I was reading in the news, I think it was last week, that you've recently found new gold in Sol anomalies in your Valley project in Mali. Does that mean that Goviex will become a uranium and a gold mining company in the future?
No. We are a uranium company. We are a developer of uranium projects. I also think it would confuse the hell out of everybody if we suddenly became a uranium and gold, because no one would know what the hell to buy us for. But the reason we found the gold is on that particular license, we had 3 licenses, and one of them was fully open in beryllium only. There was very little chance of us ever finding any uranium, and was surrounded in Mali by gold companies. I mean, and some of them are putting out some stellar results. People like Roscan have been chucking out long meterages at 6, 7, 8 grams a ton. We have IM Gold just north of us, B2 Gold are producing. So we had a license that was just kind of sitting there that we wouldn't really do anything with. So I sent the geos out into the field to do some soil sampling to have a look to see if there's any potential of a large gold trend coming down, and they came back a far greater discovery than I thought. In fact, what is more interesting is not only we got a lot of gold soil sampling, the artisanals have done a bit of work as well. They fit perfectly with our anomalies, which tells me a lot. If the artisanals are mining gold on my property on the anomalies, there is gold. And in addition, we have a second gold trend that comes in on another property. So we actually look like we've got two gold trends that meet under our uranium property. That uranium property is a bit more interesting than all the others, just if you're a geologist, not as a mining engineer. It's kind of wrong. But it's interesting because that uranium property has copper and silver in it as well. So we've got a combination of now of copper, silver, and gold with uranium all in one property, which I'm sure will get my geologist very excited. So yeah, it's an interesting play. So for us, it's a value. What value it? Then we'll be looking to work with some the gold, or we'll spin a separate gold entity. But yeah, ultimately.
Okay. I'm losing Daniel.
Okay, I think we're just having a slight problems. We're just losing Daniel for okay. I think we managed to get Daniel back, but I think that Daniel's obviously answered the question. So I think thank you very much for that, Daniel. Thank you very much for that update from Goviex.
Yeah.
I think that obviously in the last part, in the last question I asked, we obviously touched upon gold again, and obviously as that's quite such a large sort of like topic, I'd now like to bring back Simon, I guess, into the conversation. Simon, we heard from Daniel that they found gold anomalies in the Goviex deposit. You're obviously a newsletter writer. You frequently write articles on gold. With gold at 1800s, what's your view on gold over both the short and long term?
Yeah, well, I mean, I recently wrote an article about FOMO and fear of missing out, but I feel that we're very much at the start of the journey rather than the end of it in terms of where the gold price could go. One thing I would say is you kind of need, the price can move very, very quickly when it does take off, and the whole idea of this market, and it reminds me a bit about the property market as well, is that you need to get in and get out as well. Everything is a cycle. The last thing you want to be doing is sort of holding the baby when the market's crashing. And I think there's a lot of people who went into the property market perhaps thinking about investing, 50,000, and now they're in sort of well over what they were initially expecting. And the same happens, or has happened with the gold market. At the moment, there's a huge amount of value added to picking the right stocks that can really explode. But when you get a real bull market, and I'm talking about what happened in the 1970s, late 1970s, you could literally put a list of gold mining companies on a dartboard, close your eyes and throw a dart, and you'll probably make money. But you do need to have a strategy to get in and also get out.
And Marcel, what's your outlook on gold? Does Pathway Capital have any gold investments?
Well, we're extremely bullish on gold. As I mentioned earlier, I think gold is going to go much higher than people think. Over the last number of years, we've been incubating a number of companies. Sunpeak in each of those companies, people who have had repeated success in the similar geological environment as to where they're operating now. Those companies are Sunpeak Metals, focused in Ethiopia, it's gold copper play. Procura Resources, focused in gold in Peru, and as well as Eclipse Gold, focused on gold in Nevada. We have one copper company, Solaris, that has some copper projects, but also has some great gold targets. But we're big believers in Pareto's law. So what we try to do is, where 20% of people create 80% of the value, and what we try and do is focus on finding that within that the top 1% of people create the vast majority of value. So our focus is finding top quality management teams and supporting them. And in the space of gold, we have a few of those, and at least historically it's led to great results for us.
Mm-hmm. And for yourself, Simon, you kind of mentioned there's the article you wrote recently about the fear of missing out. If people haven't already invested in gold, have they missed out? or is it or like where do you think the price of gold will actually go and the top?
Well, I think you go a lot higher, but I think that if you want to get into the market, then I mean the average all-in sustainable cost. If you look at the World Gold Council, you know they're coming in at sort of just over $1,000 an ounce. You know we've got a spot price of about 1,800 now. You know that's already a huge margin, but I think that anything sort of less than $2,000 an ounce, I'm very comfortable getting into the market at that point. But if it really does take off, I would rather be selling than buying. And you know we've already got some stocks in our little portfolio that have gone up tenfold. And if we get anything like over $2,000, you know I'm expecting a lot more of those. And it's you certainly haven't missed out, but I wouldn't sit on your hands for too long.
But
And yourself, Marcel, sorry.
Yeah, sorry, Andrew. I worked in the gold industry before the uranium industry. I mean, and I used to be an analyst. I mean, gold used to trade multiples of NPV, and NPV a lot. You know, I mean, do you not think gold has become commoditized over the time? And we've been through some massive shocks out there, and gold has kind of just shrugged it off every time. You know, I mean, I get with the price, you know, and you're right. I mean, they're making good margins. What is it that's going to drive gold higher when gold companies can keep making good money at the prices they're at now?
Well, it's a very small market compared to a lot of markets out there. You know, the bond market and equity market. And I mean, if you look at what's happening, you know, before COVID, you already had negative interest rates. And one of the big negatives for gold was it doesn't yield anything. So I think that when people are putting money into bonds and they're getting less money back, and obviously you add inflation to that, I think that's going to bring a whole new type of investor into the market. And I think also dividends. I mean, the supply chain in gold is much shorter, like I'm sure it is with uranium, than a lot of other companies. And a lot of gold companies are still paying their dividend. In many cases, they're increasing it. And I think a lot of people want income. And if gold companies are still delivering income, you know, they're going to attract a new audience.
One point I'd add to that is as well as the actual annual production is around 1% of the actual amount of gold out there, and so it's not too dramatic to the impact on the price of gold. It really is a tiny industry, as Simon mentioned, and when the generalist investor shows up, it can lead to substantial increases in the price because it's just there's not a lot of names to invest in. And it's such a, I think in any one of the fangs of the whole mining industry would fit well within.
Yeah, and I think adding some fire to that is, I think this time as opposed to the last run in the gold price, we've got low oil, you've got deflationary pressures on labor cost, and I think you're going to see a sort of outperformance of the margins of the gold companies that are going to make them have better fundamentals than the past. And you know, I think the generalists are going to find that very attractive, and that money is going to drive the value.
Do you see gold companies reverting to where they were in the early 2000s when hedging became their thing? I mean, Anglo Gold took a whole strategy becoming a dividend yield company. You know, which is, I was just bouncing off what Simon was saying there. You know, the divvy yield. Well, that became the whole mantra for the whole gold industry, which is everyone wanted to be a divvy yield play. So hedging came in. Do you think that's going to happen again this time around, or do you think investors are so sworn off hedging that will never be allowed again?
Is that to me?
Whichever. I got three gold balls here I'm looking at.
I think everything's possible. You're going to see companies taking differentiated strategies. I think you're going to see you know, the next kind of aggressive Barrick growth story. I think you're going to see those that are going to try and attract the conservative money with dividends, and you know the big companies are going to differentiate themselves. And you know, I think you might see some as the gold companies become more fundamental in their valuation. You might see some big mergers between copper and gold companies to create you know, the next BHPs. And I don't know, there's, I think, lots of things are possible with the strength of earnings and cash flows you're going to see coming out of the major gold companies.
I think just to add to that, which is something that has changed the dynamics of the market significantly, is this pandemic has meant that certain mines have had to close down. And normally, if you're buying into a producer, you know, you've got a view on the spot price, you've got a view on the costs, and obviously there's debt for producers. And you know, providing you believe that the spot price is going to be comfortably above the costs, you're not really worried about the debt. I think at the moment I'm not really that worried about the debt, but if some of these producers have long periods of not being able to produce because of the pandemic, then in certain instances I think that debt could become an issue. So I think that, you know, it's there's quite a lot of moving parts in this market, so you do need to kind of keep on top of what you're doing.
I think without further ado, I think we're going to have like a poll at this stage, but I think in the interest of time, we're going to jump on to our next mining update. So thank you very much for that sort of debate on gold. But our next speaker is Scott Treblecock, CEO of Core Mining. You've already heard Scott speaking, but Scott has over 25 years of experience in the mining industry. Most recently, he was Chief Development Officer of Nevsun Resources, responsible for the strategy, corporate development, investor relations, and exploration. Nevsun sold to Zijin Mining for $1.9 billion after a year-long contested defense process led by Scott. Scott also drove mergers M&A activity at Nevsun, including the 2016 activity of Reservoir Minerals, and also led Nevsun's investor relations program for almost a decade. So without further ado, over to you, Scott.
Okay, thanks, Andrew. I mean, if you could just put up the a few points on Core Mining. I joined Core about 13 months ago. I did so, you know, for a variety of the reasons we've been discussing with this panel. I had a fundamental belief as a mining executive looking to build a new business that it was best to build that business in the precious metal sector. So I made the personal call that coming out of Nevsun, which at that point was really a base metals company, that we were on the wrong side of a long economic cycle to be building new businesses in the copper and zinc space. So I looked around Vancouver, came across this small company that put together a great portfolio of assets, and I joined about 13 months ago to lead the company. And what I liked about the company, and I'd actually like to hear from some of the panelists, the key strategic choices we've made at how to move Core forward. So Core has a portfolio of advanced gold projects. So we're not a one-trick pony. We actually have 4 100% owned projects. 3 of them are district scale. They're all in safe and stable North American jurisdictions in California and British Columbia. Our most advanced project, we just completed a PEA, has a value of $343 million, 44% IRR on a low CapEx. It's a great, simple heap leach project in Imperial County, California. And we're currently trading at only about a 0.2 times NAV for the valuation of that PEA, with no value for exploration. So Core still looks very cheap to peers. However, the key strategic choice, and one of the things I wanted to get straight with the board before I joined the company, is that we were going to pursue both exploration and development in parallel in the same company. And you often hear investors talk about needing a singular reason to invest in an equity. And that, in this case, most commonly would be the PEA for Imperial is the most near-term value driver. However, we've got these 3 other district scale projects and the other exploration project in the company. So we looked around the market after I came in the company, and we approached Eric Sprott, who, as we know, has been sort of splashing money around the junior sector. And he agreed with the strategy of exploring the portfolio in parallel to de-risking the development project, because that's a much less news-rich path to follow. So Eric has put 3 investments into Core for a total of about $12 million. We're currently closing his last financing for $7.5 million. That'll make him a 25% shareholder in the company. Management still owns 38%. So we're still in the very early innings of building a new gold company, and we're just starting to get some traction in the market. I put together a great management team, brought in a chief operating officer, a fellow named Marc Leduc with a long history and experience in the junior golds. He's a heap leach expert, which our Imperial project is a heap leach project. And most importantly, he worked in California, where he got the Castle Mountain mine going for Newcastle Gold, which eventually sold to Equinox. So, Core is set up right now with a big investment from Eric Sprott to drill. We're currently drilling at one of our BC projects called FG Gold. We're having great success. We're launching an exploration program on our California project right now to make new discoveries on our district scale land package. And in parallel to that, we're permitting a new mine for production. So I think we've set up a great story about that investors are going to look hard at, because we're delivering news flow, and we know retail investors need that constant touch point and news flow from a company. We've got the great fundamental value drivers of 4.9 million ounces of gold in the ground, plus a high value project at that $500 million Canadian NPV project at Imperial. I think all those things stack up to being a lot of great reasons that Core can make a really good run in this gold market. But I think that's strategic choice of not having one specific project to back the marketing story of the company so far has been successful, but I'd be curious to hear from the other panelists what they think about exploring a portfolio versus having a singular, simple story to present to investors.
So turning to the other panelists, perhaps I can turn to yourself first, Simon. Do you have any kind of questions for Scott?
Yeah, I mean, I like his approach, to be honest, as an investor. I mean, I also raise capital for mining companies, and one of the things, especially with institutional investors, they all want a route to cash flow. And I think, what Core has got is it's kind of got the best of both worlds in a way. You've got your route to cash flow, but you've also got that potential for some good exploration results. So, I think the investors will like it a lot, both institutional and retail, because retail investors, they tend to be more looking at sort of, I call it the fantasy of exploration. Quite often Mother Nature's very kind to you, but sometimes it isn't. But at least if you've got projects where you don't have all your eggs in one basket, then, that's great from an investor's perspective.
Yeah, and that was an important choice. We spent a lot of time at the board about capital allocation. How do you allocate, capital across our projects? And obviously you want to attack your highest value opportunities with the drill bit, but like you said, sometimes Mother Nature can be unkind. But I think having that portfolio gives me confidence we can continually, add ounces in the ground and de-risk projects and hopefully create shareholder value. Yeah.
I think it's a good strategy. It pleases both the long-term and the short-term investor. Other thing I'd point out is, our mantra is always about people and quality of people, because that's who creates the success. And we are definitely fans of Scott. We've known him for a while, and he's had great success for his career. Marc Leduc as well. So, and also specific success in that area. Marc Leduc's had. So it's a great team of people. One question I got for you, Scott, is what would the scale of the program and timing of your drilling programs be?
Yeah, it's a good question. So we're just in the process of closing $7.5 million in new capital from Eric Sprott. 1.6 million of that was Canadian-oriented flow through. So we're allocating that directly to the drill bit on our FG Gold project in Canada. That should give us, somewhere between 5,000 and 8,000 meters of additional drilling over the next 3 months, and that's really going to feed near-term news flow. We've been excited about the first few holes we put in that project. And at that project, we're actually re-drilling an existing resource to reinterpret it and then looking to extend and grow it. So I think that should create some good news flow. We're then should follow that up subject to permitting at whichever California project gets a permit first, either Long Valley or Imperial, with another 5,000 meters. That should hopefully start in the fall and continue through the rest of the year. So kind of the mantra between myself and the chairman is, keep a drill running in the company at all times to make sure we keep that that news flow feeding the market. But we will be permanent, I guess, Marcel, another way to answer your question, for a lot bigger programs if we had additional capital. So like all companies, it's price and market dependent when and how much capital we raise to how hard we attack those exploration opportunities.
Can you perhaps talk a little bit about your new exploration program at Mesquite East and Imperial West?
Yeah, absolutely. So after I joined the company and after our first Eric Sprott investment in August of last year, we went and staked 21 kilometer strike, or about 21,000 acres, between our Imperial project, where we have that PEA, and an operating mine in the same county in California called Mesquite. Mesquite's a great operation. It was built by Goldfields in the 80s. It's gone through several operators and now almost 25 years of operating history, now owned by Equinox Gold, and has a great reputation in the community. And when I went and talked to some of the original Goldfield geologists, some of them are, currently mining investors, and, they said that Newmont and Goldfields had the entire trend in Imperial County staked up in the 80s, right across into Arizona and down into northern Mexico. So we said, oh, we got a lot of open ground here. Let's go stake it. So we took Eric's money, staked all the ground, and we've gone out now with geophysics and soil sampling to hone in on the targets we think we have undercover on that structure. And we're looking to discover a new Mesquite or a new Imperial. And we've got some really exciting targets. So follow-up geophysics underway right now. Permitting and drill pads has just started, and we'd expect to be drilling some of those targets in the late fall.
Okay, we've got a few questions that have actually come in. We've got one again from Jacob Ambrose Wilson. Scott, how has the elevated gold price in 2020 impacted core mining at its current stage of exploration?
Well, I mean, it's a very simple answer. It's given us access to capital. I mean, a year ago, Core was a 30 million Canadian or less small company, had a nice portfolio of projects, but couldn't advance them because it, didn't have the size to raise capital to, as Marcel put it, to put scale into our drill programs. So the market right now gives us access to capital, it gives us choices, and it's given us the confidence to pursue this aggressive strategy of, giving Mark Leduc money to go permit and get a mine going at Imperial while drilling at the same time, because drilling is capital intensive and you need access to capital to fund that strategy. And the gold price and the markets give us that confidence and give us access to that capital.
When I always hear about California, I always associate California with being quite green. And maybe this is just me being a little bit like naive here, sitting here in the UK, but I say, California is green. It's therefore quite anti-mining. It therefore must be quite hard to go and get permitting. What's kind of like wrong in that sort of like thesis and that kind of way of thinking?
About the green part of that, absolutely nothing. California has incredibly stringent standards across the board, which makes it very challenging for many types of deposits. And there's certain places in California you would never want to go and try to permit a mine because of the layers of land protection that they have across California. And most importantly, what drove gold mining out of California in the late 1990s, early 2000s was, one, the gold price, and number two, it was the backfill law. So California has implemented, I would argue, the most stringent site reclamation standards in the world. And with that, 1,300 plus gold price, we can now afford to actually meet those standards. So that's what's held back gold mining for several decades in California. However, if you can afford, and you can in our PEA at $1,100 or above, to comply with those very high standards, I would argue you should be a poster child for the NGOs about how you should build a mine, because we're going to be reclaiming this site to greenfield status. There'll be even though we're digging an open pit, we're backfilling it, recontouring it, reestablishing all of the historic desert washes, and leaving the site like we were never there. So if you can meet that standard, I think you can get a checkbox from the NGOs. But I think most importantly, to your question about permitting, in the end, like anywhere else in the world, United States or anywhere on the planet, is all about, developing the, local consent or social license to operate. And with a long history of mining in Imperial County, California, where we're located, and our ability to meet all those high standards which are really just cost, then we believe we can develop that social license and therefore get through the permitting process, which, yes, is challenging in the United States.
Sure. Okay. I think it's got about sort of like 10 minutes to go. I'm now going to sort of like open to any questions from the audience. Just one of the questions that was sent in earlier, which I'm going to pose to Marcel and Simon first, is how important from your end has ESG become as a prerequisite before making any investments?
It's absolutely, it's a very critical issue. If without the social license to operate, you're not going to go very far. And so I think when we're looking at companies, when we're trying to build companies, that skill set, it has to be front and center. Because again, it's a big issue, it's an important issue, and you have to be, to have success nowadays, you've got to be firing on all cylinders from technical to corporate marketing. Well, ESG is right there front and center with those.
Sure. And Simon?
Yeah, no, I'd have to agree with that. I think ESG is it's really a prerequisite now for any investment. And I think gold, well, all mining companies are very sensitive to ESG. So I'd be surprised if people aren't dealing with it properly when when they're going to market.
And bringing Daniel and Scott into this, Daniel, how has your company sort of I guess sort of met the increasing demands for investors to kind of have more information about how ESG compliant you are? And then the same question to Scott as well.
Firstly, I think ESG, certainly for the junior sector, investors need to look at it as much as a morality of the management. Where do management stand on these kind of things? From a junior side, I don't think it's really filtered in from an investor point of view. Most people on the juniors are after a quick buck. It's exploration plays, whatever. Does it matter to us? Absolutely. I mean, we've got substantial, and you've got to do appropriate ESG as well. It's got to suit the environment that you're in. It's got to deal with the people that you've got. I mean, we have different tribes in different places and different cultures, and you've got to make your ESG appropriate to what you've got. There is not one size fits all from ESG. At the end of the day, you're driven by what the communities need and what they deem to be appropriate. There's no point building a school for somebody when there's no children around, even though it looks like a good thing on a poster child. So, we do make clear. So very important for our point of view is that we can show what we're doing as well. Particularly even when you're in the stage, it's got to be part of it. And as we move forward on all three of our projects, and I agree with Scott's strategy on diversification. We did exactly the same thing when we came out and got other projects, because we wanted that diversification. And that's important that you're telling everybody what you're doing, and communication is key. Whether it's through ESG or whether it's just talking to government, talking to local communities, companies are good at, balancing that right. Some are very bad and tell everybody they're going to get a job, and at the end of the day, the community is disappointed. So balancing expectations as much as ESG go together.
Scott?
Yeah, absolutely. So I think looking specifically at core, our most advanced project where ESG is most critical is at Imperial. We attracted an investment from Macquarie Bank. That's the lending bank out of Australia. They own about 4% of our equity, and they have a right to finance the Imperial project. And along with their investment agreement came, obligations which we had in our own minds, but I think gives validation because they did 6 months due diligence to make sure we were doing these things, to making sure that the project was truly bankable. And when you go for a project finance facility these days, the banks look very, very hard at your ESG. So we've got, leading processes and practices in place for community engagement, even though we're in a first world place where there is not a big inequity between the power of the community and the power of the mining company. We still are following, very high standards of environmental, social engagement in the community. So I think at core, we fully embrace everything we need to do. And back to the point of being in California, also by law, you're forced to in first world jurisdictions. So it is an absolute fundamental mantra of the company that we need to do it and do it right if we're ever going to get a right to mine and build our project.
Mm-hmm. Okay. Thank you very much for that. So just to wrap up this week's 5 at 5, I'd just like to go around the panel and just ask them each one very simple sort of closing question. If they've got one prediction for the mining industry that they'd like to share with us for the next 12 months, perhaps I can ask Daniel first, then Scott, then Marcel, then Simon. So Daniel, what's your prediction for the mining industry for the next 12 months?
Yeah, good question. Pedro's part of the mining industry you're talking about. Yeah, I think ultimately we're coming to that point in the industry that we've been in a 9-year bear market. No matter what a commodity you pretty well look at, gold's usually the first one out. It generally is, leads everybody else out. I think you're going to see the industry as a whole starting to tick up across the board. I think fundamentals, massive underinvestment in our industry across the board. Capital investment, exploration investment, we're all lagging behind. So, unless we have a massive trade war out there, I think we're starting to see the beginnings of a decent commodity bull market starting to build. Early days, but I think gold is already leading us the way into that.
Scott?
I think I'll go back to the point I made earlier. I think it's expanding margins. I think the mining sector, for the first time in a long time, can really shine with even though I think I agree with Daniel, there's probably some light at the end of the COVID tunnel. I do think there's going to be a need, there's not going to be the same inflationary pressures on the labor market. I don't see the oil price rocketing up anytime soon, and those are major inputs in almost every mining operation one way or another. So I think the expanding margins, I think, is going to be a real exciting thing to watch as that starts to come into the earnings reports for the majors and the mid tiers, and I think that's just going to create a lot of excitement in the sector for the first time in a long time.
Marcel?
Well, I think the mining industry the gold industry in particular, is very small. And I think that the next 12 months, the generalist investor is going to show up. And I think that's going to lead to dramatic increases in share prices, market caps, and the price of gold. And I think new discoveries are ultimately going to be getting all-time highs with respect to value. And I also think that we probably have at least one of those in our portfolio. So quite excited about the next 12 months.
And I think that the last word goes to you, Simon.
Yeah, I mean, I actually think there's going to be a lot of M&A in the sector, because I think the money is starting to move into the sector, and people are becoming more prepared to pay for quality assets. And I think with discoveries becoming, or large discoveries becoming, more difficult to find, I think some of the majors will be happy to pay, what today you probably view as a fairly full price for some of these other companies, the explorers. So I think there's going to be a lot of activity on all fronts over the next sort of few years.
Well, thank you very much for that, Simon. And thank you very much to all of our guests for this week's 5 at 5 show. Our next episode in this time zone will be at 5 p.m. Melbourne time on Thursday, the 23rd of July. Until then, stay safe. Thank you very much.
Cheers. Thanks, everyone.
Bye-bye.